What's up, everybody? Welcome to More Space Real Estate. I'm Muoki Musau, realtor here in Leesburg, Virginia, here to give it to you real, raw, and all about my fair housing law. If this is your first time on the channel, welcome. I'm glad to have you. Go ahead and grab your free homebuyer pro kit in the description before you get up out of here. Today, we're talking about housing market crash predictions for 2021. Now, we're in August. Q3 is here. Summer's almost over. There ain't a whole lot of 2021 left, but it's still important to think about what is this market doing. There was so much talk about a market crash, or we're in a housing bubble again, right? Kind of these, reminiscing of 2008 all over again. So it's important to get a handle on what the market is doing right now and what it possibly could do in 2022. So the one significant factor that is similar to 2008 is that the economy took a massive decline. In fact, we actually did go into a recession, but it's the shortest recession in U.S. history. It only lasted 2 months. Reason being is because the government pumped a massive amount of money back into the economy, back into our pockets, into households. There was also the moratorium on evictions and foreclosures, which stopped whether you were renting or whether you were a homeowner or a landlord, that if somebody wasn't paying rent or you couldn't keep up with your mortgage, you could at least be protected for the short term. And that moratorium extended all the way up until June, where it was declared unlawful by the Supreme Court. But the thing about money and the market and the economy is that whenever you see some new money coming in, almost seemingly out of nowhere, you got to ask yourself the question, someone always has to pay for the money. So 7 things that we got to realize about the housing market in 2021 moving to 2022 is the first thing is that we are affected strongly by the economy in general. One of the ways that the Fed helped the country kind of not go into the pooper is by keeping interest rates really low. And so one of the things about is that these interest rates on 30-year mortgages are still historically low, which essentially is keeping quote unquote money cheap. And so when money is cheap, people that want money can get loans, whether it's investing, even for homes. Money is cheap, which encourages more people to buy. That's the whole point of a stimulus, is to stimulate the economy to keep people buying. And it's the case in real estate too. Interest rates were down to below 3% last year on 30-year mortgages. That's insane. When I started seeing all these numbers, I called my brother and I told him to refinance immediately. Help some people get into first-time home buyers on FHA getting a 2.65. Even just 2 months ago, helped a client get 2.75 on a 30-year fixed. So these interest rates are keeping people, keeping that demand high. People are wanting to get in while the getting is good. Hey, I almost forgot. Before you guys get up out of here, if you don't watch the rest of this video, never hear from me again, you don't want to see my bald head anymore, go ahead and get this free home buyer pro kit. It'll get you what you need to get started, to keep moving on your journey so you can get in one of these homes and get yourself more space. Now, let's get back to this thing. The second thing to keep in mind is that with all this new money coming in, it's getting a lot of people concerned about inflation. When you have more money to acquire a good or a service, the value of the money you have decreases, so you need more money to get the same thing. Classic example is Super Bowl tickets, right? Now, I don't even know what it costs to get a Super Bowl ticket now, but I imagine it's from around $2,000. But when Super Bowl first came out, tickets were probably around like $50, $75, right? That's inflation. The amount of money it takes to get one thing increases while the thing itself doesn't really go through too many changes. And so with inflation now hovering at 5%, which is 2% higher than the predicted rate of inflation per year, a lot of people are concerned, but a lot of analysts say that inflation will trend back down to 3% by the end of the year. But with the value of the dollar weakening the way it is now, it just means that it's going to take more money to buy the same thing. That's one of the reasons why housing prices are so high too, is that it takes more money to get the same thing. Also, with the shortage in homes, more people are trying to get a limited product. And so one of the things that will hopefully change in 2022 end of 2021, moving into 2022, is that inventory will increase. Now, here in Northern Virginia, close to DC, it's a slow move forward, right? Right now, we're about a little bit less than a month's worth of inventory, which is still good because 3 months ago, we were at 0.4 months, which means that if no homes came on the market, it would take, what is 0.4 of a month? It would take less than 2 weeks to sell off all the homes on the market. That's insane. And that kind of number is not sustainable. So we need more inventory to keep the demand going and also just to keep the market going. So the third thing to keep an eye on is vaccination rates. Now, this is so crazy because no one would have thought this was a thing or even was a major factor in contributing to just the activity of just regular people on a daily basis. Even something like 2 years, like when 2020 started, who would have thought this is where we are today? But vaccination rates actually increase, they don't increase the amount of inventory, but they do psychologically get people more comfortable with traveling. Sellers are more comfortable letting people into their homes. So the amount of people that get vaccinated will play a factor in what kind of market we see in 2021 moving into 2022. Right now, at the making this video, you've got the Delta variant of COVID-19 that's now raising some issues where even vaccinated people have to continue wearing masks. So the vaccination rate will play a significant factor, maybe not the most significant, but at least it will play a significant factor in the kind of activity and willingness that particularly sellers are going to have to letting people into their homes and exposing their homes to large groups of people. Fourth factor we got to keep an eye on are lumber prices. Right now, wood is the new gold. Anybody that needs wood, if you're looking to build a house, whether you're Van Meter, Stanley Martin, Ryan Builders, Ryan Homes, custom builders, if you're just trying to build a sandbox, lumber is so expensive now. The price of lumber has increased over 300% since January 2020. Right now, the price per 1,000 board feet is $1,515. So if you got any wood lying around that you don't need to use, maybe you just finished it's a very serious situation that's causing a lot of concern, not only from the US-Canada side, which supplies about 25% of the lumber that's used that's used in the U.S., but just in general, lumber prices are out of control, and some kind of alleviation will need to occur, particularly because the demand is so high, one, and also home builders are very behind schedule in terms of their predicted amount of homes that they're supposed to be building. The fifth thing to keep an eye on are travel and leisure. Fifth thing is two things, is two parts of one thing. So when it's tied to vaccine rates. When I talked about the vaccine rates, it was more of that, when more people are vaccinated, sellers will be more comfortable letting people into their homes, which will potentially increase the amount of inventory, albeit slowly. But with travel and leisure, when more people are free to travel and move about, whether it's traveling or just going out in general, they'll spend less time viewing homes. And so you might see this fluctuation of activity in the market with buyers where you'll have some periods of cooling off, like we're having one right now in Northern Virginia, as people are traveling towards the end of with August, summer kind of rolling out, and schools are right around the corner, so a lot of people and vaccine rates are high, so people are traveling further. One of the factors that's contributing to this kind of a bit of a cool down here in Northern Virginia. So I think that's what we're going to see towards the end of this year and moving on to next year. Some of these lulls around maybe the holidays, the more activities that people can do outside of just being stuck at home on Zillow or Redfin or touring homes, right? The less competition that you might see. Now, here again, when I say less competition, I don't mean that you'll have like an abundance of homes to see kind of out of nowhere overnight. But for example, in Northern Virginia, showing rates in the month of May or in the month of June were down to about 96%. So it's a small shift, and it's also dependent on neighborhoods. Some neighborhoods are still very condensed and activity is still overheated. Some others are cooling down. So it depends on the neighborhoods, but as people have more time outside the house, more opportunities to hang out, make memories where they're not just touring homes, going to open houses, or just scrolling through Zillow and Redfin, we'll see some fluctuation, some cooling down moments throughout this year, going to 2022. Now it's not gonna be crazy, but if you're actively looking in the market, it's having that extra maybe 3, 6, 7 hours to see a home, put an offer, and get accepted, where where maybe you only have one other offer to compete with or no offers to compete with. So which makes, in a place like this, it makes a huge difference. The sixth thing to keep an eye on is the changes in competition. 2020 and 2021 were unprecedented. Nobody saw it coming, and everyone was doing the best they could to just make it work. The irony about this pandemic period in real estate is that you've had the lowest amounts of inventory, but the highest, some of the highest amount of sales, of closings, of homes sold, right? Which raises the question, how is that possible? But so the inventory has been low for a long period of time, but the activity has been steady and just almost relentless, right? So it's just activity just kind of goes and goes and goes and goes. There was no lull in the fall and in the winter and then spring, high spring market in the summer. There's none of that. It was just fever pitch for the last 18 months. But as vaccine rates increase, as the amount of options people have for spending, for travel, for entertainment also increase, the amount of competition will decrease and perhaps go back to somewhat normal levels. Now, normal is relative to where you are and what your market is like. Here in Northern Virginia, close to DC, there are places that are always going to be, very competitive. So it'll be dependent on the market and then also dependent on the neighborhoods, right? Right now, there are in the $500 to $700 to $800,000 range, seeing a lot of price drops, right? So with the lack of competition, the showings kind of cooling down a little bit, prices are changing as well. But it's only certain neighborhoods, sometimes certain price points, but it's going to kind of return to something of a more normal real estate market as the year kind of comes to a close and 2022 rolls around. The seventh thing to keep in mind is that we're not, the market is most likely not going to crash, but it most likely will correct, with the buyer pool still large, but hopefully the supply pool increasing, vaccination rates going up higher. And the only reason I keep bringing up vaccine rates is just because it seems like the amount of people vaccinated improves the amount of activity that can happen outside the house, right? And also with interest rates remaining low, that's going to keep activity high because money's cheap. So more people are still going to want to get it while the going is good. So, but as long as the supply remains somewhat limited, a crash is probably not going to happen. Now, there are some of the similarities between the market now and 2008. These incredibly high, home prices, right, are one thing. But at the same time, you had all this money that was pumped into the market, which kind of cheapened, and then also interest rates were low. So the dollar, the value of the dollar was cheapened a bit. So, but which was not necessarily the case in 2008, at least not to this degree, right? In 2008, all the big banks got all the money, but this time around, everybody got the money. So we're not really seeing a market crash, but a correction is probably more likely. For those of you who are waiting to get a deal, to get some kind of discount, that is only going to happen as the supply continues to increase. That can to some degree keep up with the demand, that's when you start seeing the market kind of becoming more balanced, which means there are just more options available. All right, so that's all I got for you guys. Hope it's helpful. Check out this other video talking about escalation clauses. If you're going to compete, you got to know what an escalation clause is. You might need it, you might not, but it's better to know than not need, than to need and not know. So go ahead and check that out. Get your free home buyer pro kit, before you get up out of here, and subscribe if you want to join the team. Always excited to get new members. It's always fun from me to you. Until next time, y'all take care.